this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, November 15th, 2024. There was nothing about this week's Consumer Price Index report for October to upset the financial markets. The CPI for all urban consumers, or headline CPI, rose 0.2% last month, the same as the previous 3 months. Over the past year, it increased by 2.6%. Excluding food and energy, core CPI rose 0.3% in October and was up 3.3% during the past year. So here's the report, and you can see the all items less food and energy versus just all items. Nevertheless, these are good numbers, right in line with what everyone expected. Really nothing out of the ordinary. Nevertheless, the yield on the 10-year Treasury note crept above 4.4% this week after closing last week near 4.3%. Now here's a chart of the 10-year Treasury note, and here I am. Let's take this back 1 year, and over here on the right, you can see right now we're at about a little over 4.4. If we go back a year, that's basically where we were when the inflation data started improving and suddenly people were optimistic about the Fed making rate cuts. So we've gone really full cycle. We've been there once before back in the spring, and here we are again. Evidently, bond traders are not focusing on what is happening with inflation, but with what they expect to happen with Fed monetary policy after the Trump administration takes over. The incoming president has made no secret of his fondness for low interest rates and is already lobbying for more cooperation from Fed Chair Jay Powell once he is in office. In response, Powell stated in a recent interview that firing him is not permitted under the law, and he has no plans on resigning before his current term expires in May 2026. Hence the bump up in interest rates, even though Trump is coming in and has made clear his desire to have rates go down. In other words, the bond market believes that Powell will stay true to his word and not bend to any pressure from the White House or anyone else for that matter. Yesterday, Powell also stated that he is not in a hurry to reduce interest rates further and will defer to the incoming economic data for guidance. Based on the most recent economic data, there may not be a need to make another rate cut until something else changes. As I opined last week, that something else could be consumer spending if holiday retail sales this month fall short of Wall Street's optimistic expectations. After spending nearly $930 billion on holiday items last year, this year's figure is projected to come in around $980 billion, according to Statista. And nobody gets this number perfect, but Statistic has proven to be a reliable source for this data and very close to accurate. So take a look at that chart. The only time it dips down was during the midst of the Great Recession, and even then, really not that much considering how much financial damage was done to the economy. So we like to spend. That's the takeaway I have from this, and we like to give gifts to each other, which is nice. Now, the rise during the past year equates to an increase, this bump way over here from 929.5 to 979.5. That equates to an increase of roughly 5.4%, which is about a percentage point greater than the rate at which wages rose in the United States during the past year. And for that number, I'm deferring to, I'll have to put that up here in a minute, but the Atlanta Fed, which has the annual wage growth at around 4.5% or so during the past year. Now, that's not to say that consumers will let us down this year. They almost never do, and only under extreme circumstances. But it does illustrate just how little room for error there is in some of these numbers. In this case, if consumers spent every extra penny they made during the past year on holiday items, that effort would still fall short of Wall Street's expectations. And by that I mean combining all of their pay raise with something else. Now, that's not to say it can't happen, because since the start of this year, the personal savings rate in the United States has fallen from 5.5% in January to 4.6% in September. Consumers would have to spend all of that amount, in addition to all of their annual pay increase during the past year, just to meet that holiday retail spending goal of $980 billion. In short, the animal spirits that energize Wall Street are running higher than usual right now. Change is in the air, and just about everyone believes it'll work to their advantage. It can't, but we won't know exactly who the real winners and losers will be until we get there. And that's this week's update. I look forward to talking to you another week. Thank you.